Hello, everybody. It's Ed Yardeni. Today is actually Friday, October 25th. We usually do our morning briefings, discussions on Mondays, but we had a technical glitch with the recording, and for some reason it broke up. I think my internet sometimes doesn't want to work, so I think that might have been an issue. But this gives us an opportunity to catch up on things. Today again is a Friday. By the way, I usually talk about the weather, and the weather's been phenomenal here in New York. It's been almost a month of no rain and all sun. It's not great if you're a plant, but we have our sprinklers on, though we're going to shut them off next week. So we'll hope it doesn't stay this dry. But it's really been spectacular weather. Hope it's nice where you are. But I thought we'd take this opportunity to maybe do something a little bit different than what we usually do. First of all, Eric's not going to join me, and we're not going to have the Q&A. But Eric and I will be partnering again on Monday for the usual go round, and that's what becomes available on Wednesdays to people who subscribe to our quick takes, and then we make it open to the public on Fridays. So this one is open to the public. It's on YouTube. But I thought it'd be a good time to kind of go over quick takes and look at some of the charts there. And I guess I'm going to be promoting it by showing you all the good stuff we've got in there. So many of you, I think, have signed up for it, and you're seeing it on Wednesdays. But let me show it to some of the folks who are just joining us. So let's go to share. Sharing is caring, they say. And okay, here we go. I think I got it. Okay, so this is our quick takes. Welcome back, Ed Yardeni. I'm back. The last one we did was just yesterday. We do these daily. Usually on Fridays we send you a deep dive, which reflects something that we wrote in our institutional product. This is our product for individual investors who want sort of a more bullet point kind of analysis of what key economic indicators mean for the markets and how the markets are reacting to them. And we also try to kind of hint at how we think the markets are going to be reacting to data up ahead here. So Eric and I did a piece on risk and reward in emerging markets. I'm not going to go there. I want to go to Bond Vigilantes started voting early. As you know, the election's coming up. So here's our Bond Vigilantes starting to vote early. We got a little picture there of polling stations. And let's look at the charts. I'm going to make it a little bit bigger here because I know sometimes they're hard to see unless I do that. But the Bond Vigilantes, that's a term I coined back in the early 1980s. Every time the bond yield goes up, reporters call me up and ask me if the Bond Vigilantes are mounting up and getting ready to cause problems. And I think it's fair to say that the Bond Vigilantes are waking up and mounting up and maybe getting to cause some problems. At least the stock market seems to finally be seeing what's going on here. But it's fascinating to note, and we expected this actually. We actually expected a little earlier. Back in August, we wrote a piece on get ready to short the bond market, and it turned out that September 18th is when the Fed gave us a 50 basis point cut in the Fed funds rate. We thought it was going to be 25 basis points. What we really thought is that they shouldn't cut the rate because we thought that some other weakness in the economy wouldn't prevail and that we would see some stronger numbers. And that's exactly what's happened. The employment situation looked pretty weak before the Fed cut the Fed funds rate on September 18th by 50 basis points. And afterwards, wouldn't you know it, some of the data was revised and some of the new data suggested that things were actually pretty strong in the labor market. And then we also had some upward revisions in GDP, and the Atlanta Fed's tracking model of GDP during for the third quarter showing something in around 3.5%. I mean, there's no signs that this economy is weak. No, these hardlanders who've been forecasting a recession now for almost 3 years. It's time they give up, but some of them are still going at it. I don't know. I mean, they're going to be right eventually. But look, here's roughly where we got to on the 10-year bond yield. I think it was 3.65%, and it was right the day before the Fed cut by 50 basis points. And look what we've been doing ever since. And we thought this might happen because we thought the data would be stronger than expected. We've observed that, for example, there's an interesting correlation between the change in the bond yield on a 13-week basis and what's called the Citibank Economic Surprise Index. And we thought the Citibank Economic Surprise Index could start going up, and it has. And as a result of that, the bond yield has been going up. And a lot of people are scratching their heads because what's going on here? The Fed cut by 50 basis points and the bond yield's going up. Part of it is because economic growth is turning out to be better than expected. And that seems to be one of the variables that affects the TIPS yield, the tax, the 10-year bond yield that's inflation protected. And so you can see the inflation protected bond yield's gone up on better than expected growth. But the difference is basically viewed as an inflation premium, an expected inflation premium, and that's gone up as well. What is bothering the bond vigilantes? Well, an election is coming up, and we thought that was kind of strange that the Fed not only cut the Fed funds rate by 50 basis points on September 18th, but they also signaled that this was just the start of a major easing process. There'll be many more cuts to come, and they seem to be aiming for something like 2.9% on the federal funds rate. That at least is what they suggested in their summary of economic projections. They suggested that they believe that 2.9% is the right Fed funds rate to keep the economy growing and yet for inflation to stay down. Bond market obviously disagrees with that. But the thing that kind of is a head scratcher is, so doesn't the Fed know that there's an election coming? And no matter whether it's Harris or Trump, it seems like either one of them are going to increase the deficit pretty substantially. And meanwhile, we've got this automatic situation where the net interest income outlays in the federal government are just going straight up. So this is certainly of concern to the bond market. It's a supply. It's not the only concern. Inflation came down, and that helped to bring bond yields down. Expectations that the Fed would stop raising rates brought bond yields down. But now the bond market seems to be of the opinion that maybe we don't need to have rates come down because the economy is resilient, and that's been kind of our view. This is a chart that Eric devised. I think it's pretty cool. It shows the current expectations for the federal funds rate over the next couple of years on a month-to-month basis. And you can see that the current expectation, I guess, it's kind of like around 3.5%. So we're at where are we? We're 4.75%, 5% right now. So that implies that we're still going to see quite a few rate cuts here, but not as many as were thought. For example, right after Fed Chair Jerome Powell gave his Jackson Hole speech on August 23rd, and he came out as being ultra dovish. I mean, Powell is known for pivoting, and this was another one of his famous pivots from where he kind of pivoted from being restrictive and hawkish to being suddenly uber dovish. And so we had this decline here. And then when the Fed came in with 50 basis points on September 18th, again, this is August 23rd, the Jackson Hole dovish speech. This is the forecast of the market, futures markets for the federal funds rate immediately after the 50 basis points cut. And now look at where we are now. And that's mostly because economic indicators have come out stronger than expected. In addition, we and others have been kind of pointing out that, it's not quite mission accomplished when it comes to getting inflation down to 2%. They're close, but there's still some areas of inflation, like what Fed Chair Powell called the super core inflation rate, which remains fairly hot. This is remember we looked up here at the bond yield and we said this spread is expected inflation as measured in the bond market. Well, we took the spread and we did it for the 10-year, we did it for the 5-year. And you can see that this is not something that the Fed should welcome. They cut rates by 50 basis points and expected inflation goes up in the bond market and the bond yield goes up. So we're still like apparently in a relatively contrary position of saying none and done. I guess the markets are still expecting 25 at the November meeting right after the election and the December meeting. But we're expecting that the Fed's done for the year and then ask us again early next year. We might say the same thing, depending how things shape up. Meanwhile, this is an interesting chart showing the expected inflation premium in the bond market. So that would be the blue line over here. And the red line is the oil price. And they tend to be extremely closely correlated, which makes sense that the bond market would give a lot of weight to the price of oil. Energy matters a great deal to inflation. It's in everything, basically. But we have seen that even though the price of Brent oil came down, the expected inflation is still high. So again, that's a pretty strong signal from the bond market that the Fed really did too much too soon. Maybe shouldn't have done anything, just waited. We've also had the posture belief that the dollar is going to remain relatively strong. It didn't look that way here. It's a pretty volatile series, obviously. But as the markets are starting to rethink about how many rate cuts we're going to have from the Fed, the dollar has strengthened, especially since the Europeans are talking about continuing to cut rates, and the Japanese seem to be backing off some of their strong stances. Meanwhile, the precious metals continue to do really well. We did see this kind of breakout. We had a line here before showing that it broke out actually over here, but now there's another breakout line that goes all the way back here. And we think that continued to be the case. I mean, could we see 3,000 on gold? I think that's probably what we are going to see. And I think it's related to a few things. Gold traditionally is viewed as an inflation hedge, and maybe the gold market is starting to think that if the Fed's going to ease into a new administration that's likely to continue to step on the accelerator with fiscal spending, that's got to be inflationary. So that could be a concern. And then, of course, the geopolitical risks aren't getting any better. The situation is we're all waiting for to see what Israel does in terms of taking out some targets in Iran, and then will Iran say, "Okay, we're not going to play tit for tat. We're done," or will Iran come back and do some more? But clearly, the situation in the Middle East remains unstable. The situation between Ukraine and Russia remains unstable. North Korea, for God's sakes, is suddenly sending troops to help the Russians. That's not a good development. So the precious metal should continue to do well. We would remain light on the bonds. I mean, four and a quarter percent on the 10 years, fairly attractive. But I think let's wait through the election here and let's wait to see what kind of political mix we have. Will we have a Republican sweep? Will we have a Democratic sweep? Will we have gridlock? If Trump wins, we'll probably actually have a Republican sweep. And the market may like some of his policies, but on the other hand, a widespread increase in tariffs would be inflationary, and the bond market wouldn't like that very much. The bond market probably wouldn't like his policies that widen the deficit. Harris is clearly talking about more spending. She thinks she's going to be able to fund it with more tax increases on upper income taxpayers. But I think with Harris, you're less likely to get a sweep if that's the case, and then she might get her spending and not get her tax increases. But anyways, either one of them look like they're going to be increasing the deficit, and either one of them look like they're going to continue to step on the accelerator, as keep the foot on the accelerator when it comes to fiscal policy. And that at some point, the Fed may have to realize that it's foolish for them to be lowering interest rates if fiscal policy is one of the reasons the economy is doing so well. With regards to the stock market, we thought that the NASDAQ could get to a new record high. It's at a new record high today, anyways. Um, but we're still sticking with our 5,800 for the S&P 500. We're actually above it. We came back below it the past few days. Kind of stick with it. We just want to we just don't want to join the crowd. Everybody else is getting wildly bullish here, so our contra instincts are coming out a little bit. We're kind of thinking maybe we had the Santa Claus rally already, and the rest of the year is going to be a little bit trickier. Nevertheless, we're still bullish. We think 6,300 next year, 8,000 by the end of the decade. Still talking about the roaring 2020s. So again, take a look at our quick takes. Most of our morning briefings on Mondays are in fact based on what we do in our institutional product. Our morning briefing for Mondays. This is just a couple more looks. This is the front cover curse. The Economist ran a front cover story about the U.S. economy being the envy of the world. Oh, you may have seen this Goldman Sachs study that said that stocks are going to be punk returners of give you an annual return of only 3% per year over the next 2 years. I have to believe that the economists and investment strategists of Goldman, are serious people and did their homework, and that's a very legitimate conclusion on their part. On the other hand, if Goldman's telling their clients and the rest of us that we're not going to do any better than 3% per year, isn't that an invitation to go to Goldman and say, well, what can you do to beat that? And Goldman's got all these alternative investments and other kind of instruments that they can sell us. So I'm a little skeptical. I mean, Wall Street's not that independent. We're independent, and our independent call is that the market's going to beat that by at least twice as much. I'm pretty sure they're talking about total return being 3%. So by the way, before inflation, but even 3% before inflation is pretty bad. You can see that the total return trend for the growth rate has been more like 11%. And we think that'll continue. We don't see that that's necessarily going to change. We do point out that dividends. If you reinvest dividends in your portfolio, dividends account for more and more of the return. So I don't know the extent to which they really factored that in. Another thought is valuation. I mean, it does make sense if let's just compromise and say, okay, it's not going to be 3%, it's not going to be 11%, it's going to be 6%. And I think one of the Goldman arguments is, yeah, but if the PE is too high, if you cut that in half, then instead of 6%, you get 3%. So you still get 3%. But we're doing some work on the valuation multiple. The valuation multiple is partly dependent on interest rates, but it's also partly related to the perception of when there might be the next recession. And this economy has demonstrated it's very resilient, and it didn't cave in on all this recession talk. And maybe it'll remain resilient. I don't want to say it'll never have a recession again, but maybe we won't have one over the rest of the decade. I mean, we basically had a recession scare already, and we're still, again, in the roaring 2020s with productivity making a comeback and profit margins doing well. So that's where we're coming from. So take a look when you have a chance. Let me thank you for tuning in, and I hope you enjoyed this kind of somewhat different presentation, focusing on the quick takes. Have a good weekend, and we'll see you next week.